Coming to you live from downtown Detroit, this is Benzinga's PreMarket Prep with your host, Joel Elconin.
This is a volatile puppy here, isn't it?
And Dennis Dick.
I'm bidding a penny. I will buy the stock for a penny.
With everything you need to start your trading day.
Good morning, everybody. Welcome to this Friday edition of Benzinga's PreMarket Prep. I'm Spencer Israel here with Joel Elconin and Dennis Dick, and we're going to talk about interesting day in the markets yesterday. Of course, the horrific events in Spain. We're going to discuss whether the impact that did or did not have on the market. Also, apparently, no one buys shoes anymore. So we're going to be talking about Foot Locker and Gap and Deere and the other big earnings that are reporting yesterday and this morning. Our guest at 8:35 will be Ryan Craver. He's a retail expert. He's going to talk it all through for us. And also at 9 o'clock, we'll be entering a debate between Ivan Feinstadt of Tigris Financial Partners and Chris Irons of Quote the Raven Research about Herbalife. So a big show on the docket for today. Joel, how we doing in the spoos?
We're getting a little back from yesterday. We're up 275 at 32 and a quarter. Pre-market high 34. I see no resistance here until we get to 24.42. So see if we can mount a little rally. On the downside, you have the close from yesterday at 29.50 and yesterday's low 27.75, but they got to print in before 5 o'clock at 23.75, and the pre-market low is 24 and a quarter. So a little after hours action took it down a little bit more, but trying to hang in the 24.30 handle. We have crude trading up 13 cents at 47.22. Take a look at the crude chart, the daily chart, see if we're finding any support in the crude oil market here as we pull it up. Also, gold. Gold over $1,300, $1,301.30, up $8.90, and silver in the green by 17 cents. So a little flight to quality, maybe, Dennis, here in the precious metals markets.
I don't even care about the precious metals. I don't care about the S&Ps. All I care this morning about is shoes, because this is honestly an epic disaster here. Foot Locker down 20% more. This stock in 3 months ago in May, it was $77. It's now $38. So I've come to the conclusion here this morning that nobody needs shoes anymore. Listen, and I just tweeted this out. If you're following my Twitter, I've already spoiled my joke, but everybody stays in. They order off Amazon. They work from home. They eat their Domino's pizza. They watch Netflix. Nobody leaves the house anymore. What do you need shoes for? Seriously, what do you need shoes for?
What's coming to this world with these millennials?
All right. Well, Dennis, when's the last time you bought new shoes, huh?
I don't buy new shoes. I don't need shoes. I order Domino's pizza, watch Netflix, and trade my stocks. I'm good to go. I don't need shoes. Who needs shoes? Anyways, in all seriousness here, give us the number, Spencer.
They're bad. So Q2 adjusted EPS. Yeah, adjusted EPS for the
whole theory is right here in these numbers.
62 cents is what the adjusted EPS is. 90 cents was the estimate. So they missed it by a lot. Sales of 1.7 versus 1.8 billion dollars. That sales does include that. The Q2 results do include a $50 million charge from a legal decision. But the big number here is the EPS just missing by a lot. 28
disaster. Epic disaster. So, if you thought that it was all priced in, you were wrong. I mean, when you miss earnings by that much, you're going down, and you're going down hard. And it's down 19.8% here right now, trading at 38.20. Do I know where the bottom is? No. Maybe Joel does. He's good with his levels. Maybe he can find you a level to trade this thing off of, but I don't want anything to do with any shoes right now. This just every day. It's Groundhog Day around here, Joel. We have a retail stock disaster every single day. Even when we weren't in retail earnings season, they were somehow finding a retail stock to destroy every day. I mean, this is just annihilation here for Foot Locker. It all started it all started obviously on their last quarter when they gapped down $10, but you didn't think they're going to gap down another $10 because it's a $47 stock now. So the $10 gap down back in May was only like 12%. Now the $10 gap down is 20% because of the lower price. This just is awful.
I'll give you one number here on the downside, Dennis, and I want you to get your bid out there right now. Back in February of 2014, we had a low at 36.75. So I don't want you to miss it, Dennis. I want you to get out there at 36.75.
No, thank you.
Okay.
What's the pre-market low?
With pre-market low, we're just holding above the lows of the session. Pre-market low 38.11. We just made a print there, 38.13. So starting to find some support in the $38 area, but 36.65 is my number. 39.29 has been the highest level since you made that low.
A report this bad is going to spill over into everything. Obviously, your direct hit is going to be Nike. Nike sells their shoes in Foot Locker, and it's trading down 3% in the pre-market. But if you want to go through and have a party, let's look at all these shoemakers. I did a little search to find all the listed shoemakers out there for you. You can go Finish Line, FINL. That's trading down a cool 5%. Maybe just getting the party started here. Let's continue on. Skechers is not traded here yet, but it is offered down in the pre-market. You can go over to Deckers, DECK. They have not traded down yet, but they are offered down as well. DSW is another shoemaker. Again, has not traded because these things don't trade much in the pre-market, but is offered down. GCO is trading down a little bit. Genesco. You could even go into like Steve Madden, SHOO. That stock's been hot, but I don't know if this is going to be enough to take Steve Madden down or not, because that's been a pretty hot stock as of late. But anyways, SHOO, you can go there. I think you're going to see stocks like Under Armour get hit. UA, it's trading down significantly. I would say Dick's Sporting Goods is going to get hit, which
But it
it's
already
doing,
did.
but Dick's already got murdered. I mean, okay, so maybe it gets hit a little bit more here on this news. It's actually trading down 60 cents in the pre-market. So, you look at all this and you think even Lululemon maybe, because that often moves with Nike and UA. There's a lot of stocks that are going to be moving.
Oh, I got one for you.
What do you got?
Maybe you can find a bid in this one to hit.
What?
Crocs.
The holes in shoes already. Crocs is trading down 1% in the pre-market too. But Crocs, listen, Joel, your Crocs, people wear those in the house. So I don't know if it's directly impacted by my whole theory of people don't leave the house anymore. And Crocs has been hot. Look at that stock. Where were we on this when we were coming up? May, it's been straight up. This is like the counter Foot Locker trade. So people staying in the house, they don't need their outdoor shoes. They don't need those Foot Locker shoes. They need their indoor shoes. They need their Crocs. And we look here, Crocs is up 50% in the last 3 months. Foot Locker's gain or losses, Crocs gain. Look, we came up with a pair trade.
Look at that. Crocs. Hit 970 yesterday. Let's see what it's doing in the pre-market. 919. It's traded down just a little bit. Just a tad, but
direct ones, is Nike, Finish Line. Think about those.
What
ones.
About Payless? Do they still trade? Payless Shoe Source?
Payless long gone.
Shoe Carnival?
Shoe Carnival could be. SCVL, that's another one. Shoe Carnival, SCVL. We'll bring that. That one's a thin one. And it's been getting killed too. I mean, a lot of these have already been killed. So, and we know Sympathy has been working as well. But when you have something down this much, I got to think it's going to spill over. And you know what the funny thing is? I actually, after last night, I was like, you know what? Retail might actually have a pretty good Friday because, we had good numbers from the Gap, good numbers from Ross Stores. The XRT was trading up after hours. I'm like, you know what? Actually, maybe a little relief rally. I think this Foot Locker just now obviously comes into the party and destroyed the party because I think your retail XRT is going to be down here now. Not only that, I think stocks like Macy's, Kohl's, which would probably have rallied on the GPS numbers. GPS had pretty good numbers. Could be down here too, just because you have such a disaster in the sector. And I think the continuation of the selling in stocks like Macy's could continue here even today, even though Macy's is flat right now. But there was some good news there last night, so we can move away from the shoes for just a second.
I want to
give
point
us those
out,
GPS Ross Stores.
All right, I'll give you the Gap, but I want to point out a comment that Flack UK made in the chat. If you actually listen to what the CEO said on the call, it's not that people don't want shoes; it's that people just don't want the shoes that Foot Locker has. They just don't have the good inventory right now, so they just have the wrong kinds of shoes. Dennis, it's not that people don't want shoes.
The CEO said that.
Yeah,
read the quote. No, that sounds horrible.
Okay.
People still want shoes. They just don't want our shoes. Is that what he said?
Here. Let me find the exact quote. In addition to working with our vendor partners to identify and capture new trends faster. That's the relevant part. But I mean, I don't have an exact quote, but he did say, that they just don't have they don't have the right inventory right now. So that's why they expect comps to be down 3 to 4% for the fiscal year. But they just need to identify trends faster. They just don't have the right inventory right now. But here's the quote. Sales of some recent top styles fell well short of our expectations and impacted this quarter's results. So don't have the right shoes. But anyway, I want to point that out. Great.
So their execution is bad too in a market where people don't leave the house.
Okay, sure. I just want to point that out.
Lots of reasons for the stock to be down 20% today, folks. And those comments
How about
are
a close?
probably even more of a reason, in my opinion. I don't think that lightens the burden here when you say, oh, well, we did it wrong. Well, obviously you did it wrong, but, it's down 20%.
Why don't everybody in the chat just throw in where they think Foot Locker is going to close today? We won't go for a high or low. Let's just do that for fun, and let's cover. Let's go into some more stocks.
GPS. You want GPS? So
give me the numbers.
So Q2.
Give me the numbers, and then I'll give a rant on this one too.
All right, Q2 adjusted 58 cents versus 52 cents. Sales of 3.8 versus 3.77 billion. Comps up 1%. They're also raising their fiscal year EPS by 7 cents. So that's good news. Okay.
So, okay, it was good news, and it was a pretty good quarter, overall. But you look at it, and this stock traded up to 26.38 last night. 26.38. It got back all of its losses for the last quarter. Those gains don't last long in this market, though, because there's so many people underwater in this thing. I mean, you just go out to a weekly chart or a monthly chart, and you can see, Gap was obviously $45 back in 2014, and so there's a lot of people underwater here, and they came in last night with their selling shoes on. So it looks awesome that it's up 5% today, but the stock has already given back 2/3 of its after hours gain. So the trend is not your friend, actually, believe it or not, with the stock trading up 5% here. And if you look at Urban Outfitters, who blew it away, we talked about this on the show. Urban Outfitters, after their earnings, got up to 21.31. Look at it 2 days later. It closed at 18.94. It already has given back half of that incredible gain in 2 days. They hate retail stocks. We see a big pop, and it just gets, and more sellers just come in, and they're like, oh, thank goodness, get me out of this. Thank you. I'll never buy retail stock again. That's what investors are thinking. And you get these pops here after hours. It's crazy that people are buying these stocks up 15% after hours because they're not looking at the overall trend. When you're buying something, the overall trend is down. You're buying it up 15%. There is overhead supply, and that overhead supply comes in fast. And it came in last night, and that's why the gap is now $2.38 off of its highs.
That popped at 26.30. Go to the dailies here, and you would have probably been trying to hold out for a little bit more. There wasn't much in the 26 handle, closer to 27, but you could just see there was a bunch of highs at the 26.30 area. Then it snuck through that one day and then came back down. But you had some highs at a bunch of highs at 25.50 to 80 area. But now, that's history. We got to look at what's going on right now. And what's going on right now is it's holding its gap from yesterday. It's holding in support here. So I'll just, not making a bet on the close here, 23.75. There's some intraday support there. You want to see that hold. If you're looking for a gap fill, it goes down to 22.90. That was yesterday's high.
And this was lifting Macy's. It was lifting Nordstrom. It was lifting some of your other retail stocks. I even noticed like Abercrombie & Fitch, A&F trading up last night. American Eagle Outfitters is trying to trade up last night. Even this morning, somebody got excited in AEO at around 540. Look at AEO at 540. What happened? That was an oops trade. That thing traded up to 13.54. Come on. Who's doing this stuff? That's a fat finger if I ever saw one. Anyways, it's right back down here, offered 11.99. Probably going to go red here today, despite the gap, trading higher. So, and if you look, Macy's is trading up. It's trading flat here again now. Kohl's is already trading in the red. I mean, you can't stop this, this flood. These stocks just keep leaking every single day.
Macy's is officially a teeny bopper here. Pre-market low is 1957. Where'd you get to close yesterday? 1962. But I just can't wait for in 20 minutes. We're going to have Ryan Craver on, and he is in charge, or the senior vice president of emerging brands at the Lamar Group. And it's been real good on the retail sector. So we'll get some of his insights here, just about 20 minutes.
All right, we'll come back to retail then, and we'll jump in with those with our guests there at 8:35. Let's jump over to Deere. DE reported here to the last night. It's actually getting bid up last night, but that's all for naught because the stock is down $6, and obviously another disaster here this morning. Spencer, details Deere.
Yeah, I don't understand it. Dear Lord. So Q3 EPS $1.97 versus $1.95, 2-cent beat. Sales of $7.8 billion for $6.92 billion. So a good beat on the sales for the fiscal year. Sales are going to be up 11% year over year. That's what they're predicting. So those are good numbers. I don't understand it.
Not good enough. Bottom line, the stock has been a great performer. Let's put this in perspective. 2016 October, $80. Now 130 got up to $132. So need to blow it away. Need to really blow it away. Didn't blow it away. That's why stock is down. So $5.50. Expectations were too high. It's trying to fill that gap, Joel. We're trying to get down at least into that gap from the earnings back in May. What are your thoughts here?
Trading down in the pre-market, as we said, 558. Your pre-market low comes in at 117.36. We're a buck above that, but you're getting into one of these chart formations, Dennis, under 120. I mean, where can you find support in this issue? That's where it gapped up last time. So for me to get some kind of interest buying this on the long side or trying to cover for a short, I'll look under $114, $113.52. That was the high before you had the big gap from last quarter earnings. So there's just, I mean, when there's nothing in there, there's nothing in there. I think that's what you've learned in these stocks. And if you're trying to buy in between 120 and 113.5, just knowing there's really nothing to lean on here. And if you're covering a short, it's a different story. But if you're trying to me, initiating long between 115 and 120, it's just, throwing darts against the wall.
Okay. We got lots of different stocks here to talk about. The chat wanted to talk about the Time Warner. Joanne Smith wanted to talk about Time Warner to AT&T. There was commentary yesterday saying that Trump wanted to block this merger from happening, but they don't think he can. So it looks like TWX might actually get acquired. That's why you're seeing TWX trade up 1% here this morning. It's at 102.50. AT&T is slightly higher here as well, although it matters more to obviously TWX than it does to AT&T. That's why you're getting the lift. So I think the takeout price, it's a confusing one because it's a stock deal and it was a ratio. So it depends on where AT&T stock is at the time. But, I think at the time they announced it, it was approximately 108. So it all depends on where AT&T stocks. They'd have to figure out the ratio to get the actual price.
Yeah, that's dependent. It's come up, right? Because the AT&T price has come up, right?
I don't know from when we announced it, though, because AT&T came up and then it sold off. It's a ratio, though, so it depends on where it is. Actually, they were trying to protect themselves. If AT&T fell, they were going to get more shares of AT&T. If AT&T was to rise, they were going to get less shares. So they were trying to get as close to that 108 without giving cash as possible. That's the way they work this deal.
Wow, complicated. So I'll let the Arabs figure that one out.
All right, let the Arabs figure it out. There is a deal to announce here, though. Last night, Calpine, CPN, and actually somebody on Twitter, and I just want to give this guy some props. I'm going to go to my Twitter feed there and just look at it from last night because this was actually impressive. They came out and they said, I want to just get the handle correct. Oh, give us the news here, Spencer.
Yeah,
I gotta go find.
While you find that, CPN Calpine is being bought by a consortium of investors for $15.25 per share in cash, or $5.6 billion.
Okay, so it was at Spark Spread is where I saw this first last night, and it was Energy Capital Partners it says that the tweet says so. Nice job at Spark Spread. Energy Capital Partners to announce agreement to buy Calpine tomorrow. Target close Q1 2018. About 20 minutes later, everybody else broke that story. So that was, pretty solid. It actually traded up on that rumor immediately. Was trading up into the 14s, and then obviously the story broke, and then the stock started trading up into the upper 14s. So your 14.87 risk arbs are putting a little 30-cent discount on this one. Obviously, the risk of the deal doesn't go through for whatever reason, but it's up 10%. So winner, chicken dinner.
What is largest natural gas power producer in the United States? Did they do a reorg or something? Because
I think they did.
Yeah,
They did do something. I think they were in trouble a while ago back, and they had to get rid of some debt. We weren't even talking like 2010.
Well, didn't Conrad used to trade this stock? This is
they did some type of reorganization. Yeah. I think they were laden with that. It still is, but somehow I think this thing might have actually did some type of reorganization.
Oh, I will just give you the pre-market high, and you could trade it accordingly. 1504. trading at 1407. So see what kind of risk Wall Street is putting on this deal going through. But since it's coming from private equity, probably will not have much regulatory hurdles.
All right. Jumping back to the earnings parade here, we're going to go to the tech stock. Somebody wanted to talk tech, and Applied Materials is a good one to talk about here because Applied Materials is actually trading up here on the day, although I get scared of anything trading up just because of that tape yesterday, which we haven't even talked about yet. AMAT, give me the numbers.
Yeah, Q3 adjusted EPS 86 cents, sales of $3.74 billion. Both, I think, were in line. Q4 guidance EPS 86 to 94 cents is what they're seeing.
Stock trading up $1.50 in the pre-market. That's good. I mean, it looks, good. The only problem is you start getting over 45, 46. Lots of overhead supply in this one here too. And that tape from yesterday makes me scared. What happens is, you got to report. And obviously, this is getting a nice little lift here. And the S&Ps are trading up a little bit here too. But you know how I like my 2-day move. And we had an ugly tape on all the tech stocks yesterday. I mean, Amazon got killed. Even Tesla got killed. Tesla never gets killed. Tesla got killed yesterday too. So I think there could be some follow-through selling there today. And in that case, I don't think I want to be chasing something up 3.5% here, even though the earnings were good.
This one, it's not too hard to make a call on this one. 45.63, that's your pre-market high. Not a lot in that area. You did have a high at 45.48, but we did get above, just touch that level. We'll keep an eye on it. And we're holding here in the 44 handle. What I would say on this one, you had the close yesterday at 44.58. Yesterday's high at 44.60. So, no, that's not the daily. You need to get down to 44.40 to fill the gap. So as long as it holds yesterday's high, I see some potential upside. But if it does not hold that, not much down to yesterday's close of 43.12. And this stock just hit new to all-time highs not too long ago. All-time high is 47.86. So still near all-time high if you're thinking of taking some profits on this one.
Did you see Exxon Mobil the last little while?
No, I have not. What's going on?
It just keeps going down every single day. It doesn't even matter. Like oil's been kind of weak, but it has been that weak. Exxon Mobil's in a free fall here right now. And maybe I'm going to get shot that 70 again. I know I bought it back at $68 back. I think it was 2016 or 2015. And I sold it at 90. I've been waiting for it to come back down to the lower 70s so I could scoop it back up here again because I obviously think that's a survivor. I don't know. What are your thoughts here? This thing just keeps free falling here. 76.26 closed right near the lows yesterday too.
Trading low for 7th day in a row. See if we can break that 7-day losing streak. Trading up only 14 cents here. 76.21 the low. I mean, maybe find some institutional bids at 76, trading up a little bit in the pre-market. Eventually, it's going to have to break this 7-day losing streak. Basis the daily charts, though, 73.55. That was your low back in February of 2016. And I think the problem with this one is a lot of people were holding on to that 80. And you got the print down earlier year, then you got back above 80, which was a long-term support level. Then when it didn't hold 80, this was 5-6 sessions ago, they're just like, we're done. And that's what you see what happened. Yesterday's low, 76.21. Crude oil, not much of a help, only trading up 20 cents at 47.29.
It's helping a little bit there, but yeah, the trend is not your friend here on any of these oil stocks. Look at Halliburton, HAL. How clean is that trend?
Let's see, HAL.
That is as clean of a trend as you're ever going to see.
Man, they're throwing everything out.
They are just hating a lot of stocks. It's unbelievable the S&Ps are so close to the highs when there's so much hate out here in individual stocks. This Halliburton was $50 3 months ago. It's 38.
Yeah, look at that. Probably the same day losing streak as you had in Exxon Mobil as well. Halliburton and how are the drillers doing? Any of the drillers showing any kind
They're all ugly too.
Yeah.
Rig, look at Rig, RIG. It got an upgrade today, but Rig, so it's trading up 10 cents because of the upgrade. But man, it's straight down too, $7.28. Just in 2 weeks. It was $9.60 2 weeks ago, $7.28. It's ugly too. I mean, Rig is one we've talked about on the show a lot of times, saying, I don't know, if oil stays down under 50 for a prolonged period of time, can Rig survive? I think that's what the market's questioning now too.
All right. S&Ps, we're staying green here. Up 275 at 32.25, $1.75 off the pre-market high at 34 even. That's a good level to get through here. because no resistance as we came down really quickly through this area yesterday. And gold still up 940 near the highs of session 1301.70.
Baba, they're talking about spinners talking about in the chat, and Alibaba, yes, did give back a lot of the gains from yesterday, but it's getting some back here this morning. Nice little pop here for the Bobster, up $2.50 here, a little follow through. I'm not sure. We have some analyst commentary or anything on Baba. I didn't notice anything.
We don't get much on that.
I didn't see anything this morning on Baba. Let me check though.
Nice pop for Baba, up $2.39.
Oh, I think that is going to be snuffed out in a heartbeat here. 166.31 after closing at 63.92. Man, it's $1.70. I mean, if you miss selling in the 66 handle and 67 handle yesterday, here's your chance. 168. What kind of volume is it up on? Any kind of volume here? Not much. I don't know. I just think this one's a fade after trading some decent volume out there. But Alibaba, yesterday's high and the all-time high, 168. And there's another thing I just want to mention. We talk about the after hours of pre-market trading. It gets overdone. I mean, there's no doubt about it. You traded up to 171.89 in the pre-market and after hours session. So sometimes you just get some levels in the, obviously to initiate a short, you have a lot of risk, but boy, oh boy, you take a long in a report like that and you have a target at 170 and it's trading up $8 on the day. I mean, use your levels, use your intuition, use your targets, because there's opportunity to get those prices that traded up almost $4 lower was the high of the day in Baba. So 171.89. You guys see that print?
Spinner is saying there was some commentary on CNBC.
Yeah, it was Kramer. It was Kramer.
Was it Kramer saying?
Yeah.
When did he say that?
He said last night. He said on Mad Money that it's still cheap.
So you think it's all Kramer?
You're the one that says Kramer.
They're influential. There's no doubt. You get these fast money guys and you get Kramer. They're all, the CNBC guys do move stocks. I mean, a lot of people say, oh, I can't watch it for whatever reasons. I'll tell you though, they do move stocks. Kramer, and I love Kramer. He's got so much personality. Maybe he doesn't get the calls always perfect, but man, he's got so much personality. He knows so much. I mean, so I don't know. There's no doubt he moves stocks. So I'm not surprised if Kramer said this go up another 45%, that it's up about 1.5% this morning. So maybe it is Kramer moving the stock there again. But I don't know if I'm jumping in here and, buying it just because Kramer said it's gone up 45%.
Yeah, I can see your finger on the sell button there, Dennis, when we were talking about CNBC. And then I'm like, oh, it's Kramer. You took it off. You took your finger off the sell button. It's not nowhere near the buy button, but you were thinking if it's one of those other goofballs that they have on there, you would definitely what was the call that some? Oh yeah, that's what it was.
Adami was saying this could get taken out for $200 or $300 a share, and GWPH trade up like 10 points on those commentary. That was insane. And you see what happens here 3 days later, 4 days later, boom, the thing collapsed. Now I think there was a downgrade in there, or there was something else that was said in there that obviously made the thing collapse. But you got to watch, like he wasn't coming saying, I've got a connection here that says this is going to get bought out. He is speculating. And people are going to buy a thing up 10% because somebody on CNBC speculates. I mean, that's ridiculous. And those people who bought up there deserve to get punished. Honestly, they did.
You know who's been really quiet, like on the breaking news and rumors and takeovers and stuff? David Faber. After that Twitter debacle, I mean, he has not.
He's connected though. So Faber is connected. Out of the people that are on CNBC, you're not going to get, and a guy, I have no problem with any of these guys, but they're just giving commentary, just like we do on PreMarket Prep. They're giving their opinion. They're not connected where they're getting inside info. David Faber is connected. Like when he says something, he sometimes gets inside info. So, he can break stories. So one thing about Faber is if Faber was to say that, then you'd put a lot more weight into it. Like, because Faber isn't going to just give an opinion. He's not on there to give opinions. He's on there to give information, and he is connected. So that's the one thing about Faber. He's not going to always get them right, but you've got to really respect what Faber says.
New lows at Foot Locker now under $38, $37.61. That's your last print. It won't trade lower than $36.75 because Dennis is going to stick a big old fat bid out there and stop the bleeding here. $37.61. That's your last print here. In shares of Foot Locker.
I'm just looking at imbalances here. Square has a buy imbalance every single day. SQ, I don't know what's going on, but Ace was pointing out, how are you doing if you're buying those buy imbalances? A lot of times, and when I give these imbalances here, And, we don't talk strategy around it that often, but I have talked strategy on the show. The majority of time is usually when I'm saying it's a big buy imbalance, I'm looking at a stock that might potentially open too high. I've always been a contrarian to the imbalances. So when I see SQ with a 55,000 share buy imbalance, I'm usually throwing sell short orders out there because I think the stock might open too high. So there might just be one institution that wants to do it. That's just the, example. Now, in some cases, if the stock's got news, going to have a big sell imbalance, it doesn't mean anything. But there's no news, there's no anything. Sometimes stocks just open too high because the big institution that wants in. There's somebody that's been buying Square and accumulating a position here for a week because every single day I come in, it's got a buy imbalance. It's the same thing with BABA. We've been talking about BABA. There's buy imbalances on it every single day forever. Same thing with GE. There's been sell imbalances on it every single day. I mean, the charts don't lie on those ones. GE has been straight down because the sell imbalance just doesn't seem to help. I mean, everybody hates GE. I own GE in my investment portfolio. Here I am again talking.
You're getting out soon. I can smell it. You're getting tired of this stuff.
I've been in 17 years. I'll be in it. I'm in it. I'm in it for the long haul. I'm stuck with GE.
You know why? Daz is not selling it because he doesn't want to figure out his cost basis. He's going to have to go back to
zero.
It's zero because you got all your money out of it.
It's actually high, but if you put the dividends and stuff in there, I've taken out more in dividends than I've got put into the stock. 17 years of dividends, you just do the math. Rule 72, right? Yep. So you get 4%, you can divide by 72, you can figure out how many years before you get your money out in dividends. That's why I like the dividends, because if you've got dividends, you're getting 4 or 5% in stocks. Well, over years, those dividends just add up. And, I can actually, for my investment portfolio, live on my dividends. So it's nice to have that cash flow coming in from those dividends, because even if I wasn't working anymore, I could just live on the dividends that my investment portfolio is creating. And then if it goes up, it's a bonus. The only caveat is if they cut the dividend. That's when you really don't like it. And that would get me upset if GE cut the dividend, because then I'm not getting paid anymore to wait.
Just taking a look at Square here, did hit 27.97 and we've pulled back. This is a Harlan Pine chart for you because you did break out after you made a 25 even high. You had big congestion at the 24.25 level, little dip under that. But then when you finally broke out from that level, that's when you had the nice run. So we'll go with old resistance, new support here. I see Square in the lower 24s. I like it. Also, just a little retracement is going. You had this $20 low up to 28. $24 is your 50% retracement area. So I'm liking the lower 24s here for Square.
Jumping over here, there was a couple earnings reports that we did miss, and we should talk about Ross Stores. I know we're going back to retail here, and we're obviously going to get Ryan Craver right here on in a minute, so we'll dig into it a little bit deeper. But let's quickly just give the numbers there, and we'll set Ryan up.
Ross Stores reporting Q2 EPS 82 cents. First, that's a 5-cent beat. 82 cents on the EPS. Sales of $3.43 billion versus $3.37 billion. So a good sales number as well. Q2 comps up 4%, and they see for the current quarter Q3 comps will be up 1 to 2%. EPS is coming in nicely. Fiscal year EPS coming in nice as well.
These discount retailers have held up so much better than the traditional retailers, though. That's one thing I will say about this. So that's why I don't know if people are just going to come in here and just sell this off, because these stocks, if you're owning any retailers, these ones have been the better ones. Think about Burlington Co-Factories, BURL. And we were only off 20% from the highs. It still sounds like a lot, but when these other stocks are off 60, 70, 80% from the highs, this has actually been an outperformer. TJX is another one. It's off from the highs, yes, but it's been an outperformer as well. If you look, the all-time high, 83.64, was trading at $71 here this morning. So off about $14 from the all-time high. Held up very, a lot better than your traditional Macy's, Kohl's, Dillard's, which have been annihilated. So that's one thing, if you're going to own these, retailers, these have been the better ones to own. I don't know if that's going to continue or not, but I don't know if I just see them coming here and selling Ross Stores like they did the Gap last night, because these stocks are already a little more loved than something like the Gap GPS.
Hold it in here at the $59 area. You got a pre-market high at $59.94. If you can sneak into the 60 handle, and if you can exceed that and get up to the upper 60s, 60.62 to 60.84, boom, that would be an area I'd have to let go of a long, or else look to short a nice whole number. But as Dennis mentions here, you've had the nice pop, but you're holding on to the gain. So if you're trying to ride this from the bull side after making that high, 58.39 That's been an intermediate low here below 58.39. You can see here on the pre-market chart, you don't have much to lean on here as we went straight up from 53 to that area.
Right, 8:35 now. Time to take a quick break. And we're going to be right back with our guest, Ryan Craver. He's a retail expert. He's the Senior Vice President of Emerging Brands at the Lamore Group. So we'll be right back.
One. Welcome back, traders and investors, to Benzinga's Pre-Market Prep, brought to you by Benzinga Pro. I'm your co-host, Joel Elkanen, along with Dennis Dick and Spencer Israel working the boards. And we have Ryan Craver on the line. He's a retail expert and Senior Vice President of Emerging Brands at Lamar Group. Ryan, how you doing on this Friday?
Fantastic, guys. Thanks for having me on.
No, we love having you on. So just one quick question here relating to the carnage here in the retail sector. It's probably going to start having an effect on jobs. And I was just wondering, are you worried about your job as the retail expert at Emerging Brands? Because pretty soon you're only going to have to cover one stock, and that's going to be Amazon.
Well, no, I'm not worried about my job. I think if you look at overall retail sales, they're actually still positive. So, we read a lot in the press about how poorly retail is doing, but there are some names that are doing pretty well. I mean, Amazon is definitely one of those. There's some off-price players that are doing very well, as you've seen from some of the numbers. Some of the home improvement guys are doing phenomenal. And then, the warehouses are still fighting. I think overall retail sales are fine. And I think I should have a job for a little longer.
Okay. If not, you got a home here at Benzinga. Let's just start out with Foot Locker here. Disastrous report. So let's say, one of your clients calls up their long Foot Locker here. They took it into the report. What words of, 37, 35, 37, 30. Is the street overdoing this a little bit on Foot Locker?
I think it's a pretty aggressive decline, but if you look at the underlying numbers and you look at where they are situated as stores, it does look pretty dire. I'm not sure I would catch a falling knife. You've got same-store sales down 6%. That is a big, big number. It's accelerated from previous quarters. You've got a margin that was at 29.5 versus 32.9 last year. So they tried to buy the quarter by discounting as much as they could. They didn't come in flat or positive. I think they are finally seeing the impact of a slowing sneaker trend. I think they're also seeing an impact of athleisure product being anywhere and everywhere. And then number three, and I was seeing some early chatter on the chat about the fact that they are in malls. They are very, very overly penetrated to malls, and malls are where the traffic is the worst right now.
Ryan, what about so what about, we move away from Foot Locker just for a second, but what about like the Finish Lines, the Skechers, the Deckers, even that sells shoes as well? I mean, Nike, what does this impact Nike even directly? Because Nike obviously sells a lot of their stores in Foot Locker. What are your thoughts here?
Yeah, so let's take Nike first. I'm not a big fan of Nike. I think that they still got some major issues with some correction on product. I think that they are still experiencing a resurgent Adidas. Adidas is absolutely killing it. Every retailer I speak to, all they ask for is Adidas licenses. I think you and I spoke about that a couple months ago when we were meeting up in New York. And, you know, I just don't see them turning that anytime soon. I think that might be a multi-year turnaround that they're going to need to do. When you talk about the other guys like Skechers and the Finish Lines and the rest of them, I think that they're all a little bit better because they're hitting the lower end. They've got a lot more clearance product, whereas the other guys are more focused on higher end. They're focused on the Yeezys of the world and the overpriced product that's above $100. Skechers, their minimum basket or their average basket that they're selling in their store is less than $50. And it's a customer that I like a lot better, which is consistent with the themes that we're seeing with the off-price world of TJX, Ross, Burlington, Century 21.
What about Shopify? That seems to be benefiting. It's a Canadian e-commerce company headquartered in Ottawa, makes software platform for online stores. So this stock is surely benefiting from this online trend. And I think you've spoke about it positively in the past on the show. Now just hit 105.79. This is a couple of weeks ago, probably after report. Hanging out at 95. You're still keeping the bullish hat on Shopify.
Yeah, so Shopify, we've spoken about this pretty much every single call I've had, and we talked about it way back when in December of probably 2015 was the first time we spoke about it. I am still bullish on this company. I think it's definitely started to get a heck of a lot more attention. I think that pop over 100 shocked a few people. I think the valuation is a little crazy, but if you look at where the trends are, people are opening up their own stores. Shopify hasn't completely increased the price to where I think that they can get for their software as a service subscription model. And they are integrating with the top marketplaces in the world. You can open a Shopify site that will not only sell on your own .com, but it will also sell on Amazon, and it will sell on Jet.com, and it will sell on Walmart.com. And that's incredibly powerful for small and medium-sized businesses to do a lot of e-commerce. They're also very, very focused on trying to steal some of the market share from Square. So you may start to see some of their product popping up in your local coffee shops and other small businesses. So I think the long-term trend for them is very, very good. Just be very careful because they obviously are in some nosebleed valuation territory.
Ryan, let's jump over here to the apparel makers. Gap reported here last night. The numbers were pretty good, but the stock is already leaking. Give us your thoughts here on the GPS report.
Gap, it's a lot of more of the same. Old Navy is the only engine that's fueling this bad boy. Banana Republic has been a negative comp store, negative international number for as long as I can remember. And what surprised a lot of people is that the mainline stores under the Gap brand were only down 1% versus 3% down last year. I can't get excited about it. I think it trades sideways for a long, long time. Maybe I might get a little excited if it dips below 21 or back below 20, but it's not a name that excites me. I think they're overstored. They're going to continue to have pain over the course of the next 5 to 10 years as this whole shift in retail plays itself out.
And out of the chat here, Michelle K wants to know about OSTK. Overstock.com here has had a nice rally. Any thoughts on OSTK?
I think it's going to stay range bound for a long, long time. They are obviously facing the big behemoth out of Seattle known as Amazon. It's getting more expensive to ship, as we've seen from UPS instituting some holiday pricing surging. FedEx has come out and said that they're not going to do so. And then the cost of bringing traffic to your site is very, very difficult, especially considering that whole Prime effect or that Prime mode from Amazon. So it's not a name that I'm too excited about within the internet space. I think if you're focused strictly on e-tailers or some other guys like the Wayfairs of the world, the ELF, Eyes, Lip, Face, which is a cosmetics brand that has both wholesale and .com business, those names seem to be a little bit more exciting to me.
All right. So a couple of years ago, we were on the show. I don't know if it was on with you. I talked about shorting the malls because I just thought eventually that this was going to come down, smaller stores or stores leaving. I didn't put that play in place here, and I don't know what kind of heat would have took it, but Taubman Centers is taking a heat. But I got a new theory now, and I'm going to test it out on you, Ryan. Okay. Are you ready?
Absolutely.
Okay. Amazon proof, right? That's what you need. You need Amazon proof. Home Depot, we kind of thought that was. Costco, we kind of thought that was. But you saw what happened to those stocks, and they're having a hard time recovering. But I was having dinner with a buddy of mine that owns an exercise facility, an exercise warehouse. He was actually contacted by Amazon to do some wholesale stuff, but it got cut off. But what about like Planet Fitness or this new IPO yoga or Nautilus? I mean, that's one thing you can't get from Amazon, right? You can't get a workout. You can't get a trainer. Eventually people are going to get off their couch, stop eating Domino's pizza and watching Netflix and, go and work out. I mean, is that an Amazon proof sector?
I think Planet Fitness is a solid name. They've had a lot of success recently. They're still in that drive to open new locations. So any health and fitness player that you're interested in that's not sustaining their business and or not opening new stores, I think it's definitely a trend that will continue. With that said, you got to focus on the fact that with this internet connected world, some of the workouts are now coming into the home. One of the names that is very interesting to me is called Peloton. So they're selling very expensive bikes in the home that will run spin classes 24/7 that are either recorded or live. So I wouldn't necessarily call it Amazon proof. I think those that are growing make a lot of sense, but there are some indications that you would start to see, a receding of physical locations because you are bringing the workout back into the home. If we've got bikes doing it today, why won't we have treadmills doing it tomorrow? I do think that there is a small impact in some foreseeable time.
Ryan, multiple people want to know your thoughts on TJX. We did talk about it just a little while ago. Obviously, Ross Stores reported a pretty great quarter here last night. It's trading up 10%. We've got TJX trading up about 0.5% in sympathy here with it. Also, Burlington Coat Factories, or they call it Burlington Stores now, BURL, is trading up as well. But the question is specifically about TJX. What are your thoughts on this one?
So I think, again, I've been very bullish about the off-price sector. I think that TJX had a pretty good quarter. I think the differentiator with TJX is that they've got the HomeSense brand. If you look at the underlying trends, Canada did incredibly well. They were up 7%. Marmax, which is the Marshalls TJ Maxx group, was only up 2%. And then they had their HomeSense group that's continuing to post 6 and 7s. So they have that growth in the home portion of their business. Unfortunately, TJ Maxx and the Marmax portion makes up about 63% of their overall sales. I was disappointed in how it traded. I thought it would do a lot better, but TJ Maxx might be to the point where they're too big and they can't take advantage of all the leftover goods from the department stores that are being sold for a lot cheaper. Burlington is a little bit more nimble, so that's why I think you see the pop in their numbers a bit more. And Ross is also a little bit more nimble because they just don't have the size. I love TJX longer term. I still think it has legs to it. I'm just a little disappointed in how it traded past the recent results.
We've been on the line with Ryan Craver. He's a senior vice president at emerging brands at Lamar Group, a retail expert. The only workout that you can't really do, like, unless you have a pool, right? So maybe we should start looking at like pool suppliers and people that build pools. But great look at the retail sector, Ryan. We always appreciate your short and long-term outlooks, and we'll be checking in with you again soon. Thanks so much.
Thanks, guys. Have a great weekend.
Thanks, Ryan.
All right, let's check Foot Locker and see if Dennis has stuck a bit out there yet in Foot Locker.
No, I did not.
No.
37.50 here now. Where did you want me to put my bid?
36.75. It went to
hasn't got there yet, so it's still trying, but it is still leaking. I mean, this just, look at the volume already here on this thing. It's already traded 2 million shares. It's not even 9 o'clock yet. This is going to be an incredible mover here this morning. Nike's still leaking here too.
I bet you this thing opens. I'm not going to make a launch anything. This thing's going to open over 38 and never see 36.90.
Oh man, I'll take you right now. I say it's these 36.90 pre-market or pre-market or a regular session.
I need like 3 or 4 to 1 on this. I'm really going out on this a limb on this one. I need 4.
You're going to give me 4 to 1?
No, I need 4. Nice try.
Yeah, you mean you need 4 to 1? No,
I do this. Look at this. Look at this thing. It's the ugliest chart ever. And I'm going out on a limb. And you're like, oh, I don't know. I made a market.
It's got to fall another 2% to get there. I don't know if it's got the gas to get there.
Not only did I say it was the pre-market low is going to be in, I said it's going to open above 38 and rally. I think I should get 8 to 1 on that.
You're not getting any of that.
Okay.
I'm going to be at 36.90. I think it trades and ticks 36.90 either pre-market or regular session. I'll go with you.
Dennis going out on a limb here. It's been a rough. It's been a rough week for him.
A limb short at 37.55 and buy it at 36.90 and make this 65 cents.
I was going to say that to you in the 38 handle, but then you would have said, "Oh, I don't know for sure it's going there."
Anyways, this is a disaster. So let's move away from these retail stocks. You know what I forgot? It's option expirations. It's the third Friday of the month.
Oh.
I was looking at these imbalances. I'm like, holy cow, these imbalances have gotten big. What's going on here? I was like, the third Friday. Yes, that's when all your institutions come to play to jockey the stock against their option positions here. I get it. So anyway, so the imbalances are huge here this morning. We're looking at a lot of sell imbalances here early, despite the S&P futures trading higher. I'm looking pretty much sells across the board. Again, this information you got to take with a grain of salt because it changes so much because so many big players that are going to come into the market before 9:30. But as of right now, the market is leaking a little bit because there's a lot of sells on the board.
All right, S&P futures are still holding up $1.75 at 24.31 1/4. Important to get through that pre-market high, and that pre-market high is 24.34. Dennis, also this is kind of just a replay back on I believe it was August 11th, and it was a week ago Friday. We were down in the same area, right? 20, and after a bad day on Thursday, you made a low at 32.75, and then on Friday you made a low at 30 1/4. That was a pre-market low, and then you embarked on a huge rally. So I think this 24.30 area, keeping above that for the close today, is going to be crucial for our trading action for next week.
I've stayed bullish here, and I stayed bullish here even through the sell-off there a while ago. But I'm starting to get a little bit concerned here with the market now. You know why? Because we did not make a new high on that last move. So when we bounced back, we did not make a new high. Now we got a big washout day yesterday here. I think you're going to see some follow through here today. I think Amazon's going to test 950. Big number for AM Zebra N at 950 there. It sold off, obviously, 20 points. It's 963 here right now. I think it can test 950 as early as today. Needs to hold that. Looking, at Apple, that stock did make a new high on the move, but man, it really got ugly there with yesterday's tape as well. I think there's some sellers out here lurking right now, and I know we're trading up here a little bit in the pre-market, but I think we could end up going red here in a hurry this morning. So I'm a fader of today's small little rally.
Are you looking at that portfolio and you trying to even raise more cash?
I get too much cash in already, so I can't. I need actually more stock, so I need the market to come in. I've been too much cash here for a while, and obviously not participating as much as I should have. And my portfolio is full of a lot of conservative stocks. I still like, I just do it a little bit different, and a lot of people are all about growth and they want to come in and they want to get rich. I'm more just protecting my wealth to a certain extent. And, getting a good, income coming at me. And that's why I like the dividends. I have a lot of preferred stocks in my portfolio. I mean, if you look at it in the long run, and you look at the markets, you're going to have these anomalies where the market takes off 20, 25% in a year. Those happen. But over the long course of time, the market, averages 6, 7, 8% a year. Well, preferred stocks, you can get 6, 7, 8% and take a lot less risk. So I've pretty much employed half of my money into preferred stocks for the last decade. And it's paid off because I've been getting paid, 6, 7, 8%. You can say, well, you didn't participate in all this rally. But you know what? During the financial crisis, I didn't get killed because I had a lot of preferred stocks as well that were okay. So getting paid through all those hard times, and the hard times will come again. That's why I've always been a fan of dividends. I feel like in the preferreds, you get a lot less, volatility. And you're not getting those 20, 25% years, but I'm not getting 20, 25% down either. So that's why I like the preferred stocks.
Wow, what about Alta here? Downward Dog is asking about it here, and that stock, once a high flyer, made a new low for the move. I'm not sure when they're reporting yet. You hit 236 yesterday, bumped up against 245. I actually kind of like that 245 level. If you want to buy this thing on strength, maybe wait for a close above 245. Thursday's high 45.10. Friday's high 45.25. Low of the move at 236. So if you're trying along, you know where you got to be out. All right, 856, Dennis. Do ratings even have any impact on a day like this?
There's a few this morning. Spencer, you want to give some highlights? There was a few. I saw United Rentals caught an upgrade from Stifel. Stifel's always influential.
Here, you know what? I hadn't looked in a minute. Let me pull them up right now.
United Reynolds.
Not a whole lot. Let me see here. We got some upgrades. URI got an upgrade from Stifel. A hold to buy. Nothing. No huge tickers jumping out to me. Double upgrade from Citi on PWR and MTZ. Downgrade wise, Monsanto got a downgrade at UBS. By the neutral, Blue Apron, great downgrade there from Stifel, wonderful, and that's pretty. That's pretty much
the party on that one.
Yeah, and that's pretty much it though. Not a whole lot going on today in the ratings.
Spinner wants to talk airlines. If we want to talk about the ratings, because he's right. Airlines have just been in shambles. They got murdered again yesterday here. You'd think with oil going down that the airlines would try to catch a bid. Not happening. I mean, they just got overdone. And we talked about this back in June and July, and stuff gets overdone. And when the ball turns and when it starts going the other direction, it can go there for a while. I mean, you can say LUV, that's been slaughtered in the last month because it was $64 and now it's $53. But let's put it in perspective. Go up to the weeklies. This stock was $35 back in October, or $36 back in October. So we went from 36 to 64, which was a ridiculous run up. So it's just correcting, really. It's in a correction phase right now because the run up was simply too much. So I did buy Spirit Airlines. I couldn't resist here. Threw it in my long-term investment portfolio. You know how I like to buy stocks, my long-term investment portfolio, when there's blood in the water. And I did throw some Spirit in there. Obviously the trend is not my friend here, but I'm sticking this in and not looking at it. So I think, when I look at Spirit Airlines 5 years from now, I think Spirit Airlines is going to be higher. And I like this whole 35 to 36 area where it's coming into. So I just did that recently. I don't own any other airlines in my investment portfolio. Delta, LUV, AAL, they all look the same. They've all been hit hard in the last few days.
And didn't Warren sell some on his 13F? Didn't he lighten up in some of the airline stocks?
He's lighting up in all of them, and that really started the party. And, and the Black UK in the chat making it good. The events in Barcelona did not help the airlines yesterday either.
No, not at all. All right, 859 comes to another end of another week.
Well, we're not done just yet.
Oh, that's right.
We're not done just yet.
Oh, sorry. I stand corrected.
We have an end of the week treat for you. We have a little debate going to happen right now. We're going to air it between Chris Irons, otherwise known as Quoth the Raven, on Twitter, and Tigris Financial Partners, Ivan Feinseth. He's the CIO there, and they kind of going back and forth about Herbalife. Before we air that, though, I just want to give a quick shout out to a few people. Shout out to Nick Donato for helping to get this set up with us on the show, and then a shout out to Chris Darascalisi, who spent some time yesterday and putting together a nice little editing this up a little bit. Not editing so much as polishing it up a little bit, but it's going to go a little over a half hour, so we didn't cut anything out, so we want to let you know that, and we're going to air that in a moment. So
am I still on? Did you cut me off?
I didn't cut you off.
I just what's better than the interview was Spencer's reaction during the interview as Ivan and Quote the Raven were going at it. So there's a good discussion here. You guys listen up. I'll be back with you Monday morning.
All righty.
We're joined now by Ivan Feinseth. He's the head of research at Tigris Financial Partners, and Chris Irons of Quoth the Raven Research. We're talking about Herbalife. And Ivan, I want to start with you. Some news in Herbalife on Monday. They're being the country is starting the Ministry of Education, the Ministry of Public Security, and a few other government agencies are going to lead a 3-month rectification campaign to target employee recruitment with regard to MLMs. And this sort of hurt a bunch of MLM stocks on Monday. Herbalife itself fell 7%. So you have a buy rating on Herbalife. And this was news from August 14th. What did this news do to your underlying thesis?
It hasn't really changed it. Herbalife specifically has a 37-year proven successful business model. The multi-level marketing or direct selling marketing has been around and been very popular for at least the past 50 or 60 years, but it's really over 100 years old. And while it has received criticism sometimes in the past, it is, in my view, the equivalent of an insurance company that hires commission salespeople to sell insurance and gives them a significant commission or percentage of the premium, at least in the beginning. So I believe that companies like Herbalife have chosen the direct selling or multi-level marketing to sell their product, as opposed to more traditional marketing, where in Herbalife's case, it could just be another product that's on the shelf of a GNC or a vitamin shop and having to deal with the other costs of marketing to sell the product that way.
So, Chris, how did you interpret that news on Monday?
Well, look, I mean, I think that answer, with all due respect, is mostly nonsense and riddled with, all different types of fallacies. But look, the news could have a very profound impact on the company. I think everybody in general, especially people on the sell side that are out there pushing the stock, are ignoring what are potentially a litany of worldwide regulatory risks that still exist. So not only are U.S. regulators still not done with the company ostensibly, as we know the SEC is looking into them for Foreign Corrupt Practices Act violations in China, but also, we don't know if other governments around the world are going to follow suit. So to come out and just write off this investigation, which admittedly, nobody really knows that much about. It was reported in one Chinese media source, to the best of my understanding. There was some reporting that was done this morning on it by the Wall Street Journal that went a little bit more into depth. China is and has been the largest growing segment of the company's revenue base. It makes up right now about 20% of the company's sales. And I was reading a blog this morning on one of the MLM blogs that was laying out basically a timeline of things that they hope to do for this investigation, which I think this is all translated from the original article that came out. But, basically says that the Chinese government or whoever's running this investigation is going to put together a list of individuals that they might be suspect. And then in October, they may take action. And admittedly, to Ivan's credit, we don't know if Herbalife's even going to be involved, and we don't know if they're not going to be involved. However, to say that, this is nothing and to just write it off because the company has 50 years of experience running a business model that the FTC has come out and found to be ethically dubious. Excuse me, let me just finish my point. The company's been running a business model for the last 50 to 60 years, which is ethically dubious and doubtful. And that's giving it credit. That's not laying into it too much. But to just come out and write it off as if this is a non-event, 50 years of operating history does not predict what's going to happen this year, next year, the year after that. Stock market is a forward-looking, instrument, and I think that's a fallacy to make that argument.
Well, Herbalife only had a 37-year history, but multi-level marketing has been around longer than that. There have been no specifics, and the government itself has really not outlined all of the issues. I mean, we're really getting this third hand from various news sources. And
sure, but if you read the company's filings, there is an ongoing FCPA investigation in China right now by the SEC. Is that correct?
Not the SEC in China.
It is correct.
Okay, the SEC in China, or Okay. Well,
wait,
you're talking about
Chris,
the SEC
Chris,
in the US?
that's in the U.S. now, or are we talking
following.
about
The
China?
United States Securities and Exchange Commission. See, this is the problem. People don't even read the filings. The United States Securities and Exchange Commission is conducting a Foreign Corrupt Practices Act investigation where they have requested documents from the company. And this has been language.
Oh, okay. Yes.
Has been
So
in
you're
the
saying
company.
no, that the SEC has an ongoing investigation in China. The SEC is not investigating anything in China. They have been requesting information on companies here operating in America, but not specifically in China.
Okay.
And so I read through your note this morning, Ivan, and nowhere does it even mention that. I mean, do you discount that risk at all? Do you discount the risk of something like this news that comes out here, over the last couple of days at all in your analysis to go out and buy the stock the way that it's valued right now?
No, I don't discount it. There is all kinds of operational risk in every company, and this has been, and the ongoing concern.
This isn't an operational risk. This is a regulatory risk.
There's headline and regulatory risk that affects different companies in different ways.
Okay.
However,
I haven't finished your thought, and then I want to jump in.
Okay. This has been known for quite some time. All of this has been known for quite some time. And they've continued to, Herbalife, as I'm now specifically talking about Herbalife, has addressed this, and they continue to make changes. And at one point, they did pay a fine and have increased compliance with new rules. And this has gone on for quite some time. But I think, yes, it is a risk and it is a concern. But there are a lot of risks and concern no matter what type of business model you have.
Okay.
Well,
So
look, hold on one sec, Spence. Just give me 1 sec. I mean, that's a bit of a cop out. Number one, the FCPA language just first started showing up in Herbalife's presentations and annual reports, I think about a year ago. And so this is an entirely new regulatory angle that has been taken on here, separate from the FTC and separate from what has already taken place. And so, models need to be adjusted, risk profiles need to be adjusted in order to account for that. So to just basket it with everything else and say, look, there's a lot of operational risk that's been going on with a lot of companies, and every company has risk factors, and doesn't do justice, I think, and certainly doesn't take into account the concentration of business that comes from that segment of the world. I mean, I think it's doing a disservice to kind of cop out and just say, well, every company has risk.
Well, I'm not copping out.
This company has very
definitely
specific. Go ahead. I'm sorry.
China is one of the key growth drivers of their business. The expansion in China is looked at as a big growth driver, and I think at some point the revenue in China will exceed the revenue in the U.S.
Okay, so I want to bring it back. So that was just all reaction to the news this week, but I want to bring it back to the whole Herbalife story. So, Chris, there have been some well-known shorts in the issue, where obviously Ackman and the documentary Betting on Zero sort of highlights his crusade, his short against Herbalife, and yet he's underwater a lot here. The stock has pretty much done nothing but go up in the past 2 years or so. So how do you reconcile that, all those risks with the fact that the stock is actually, up since Ackman has gotten in?
Sure. So there's two things going on here. The first of which is the stock hasn't done everything except go up. I mean, it went down to 30 on his announcement. It bounced up to 80 on a short squeeze after Icon came in. It tooled around there. It came back down to 70. It went down to 50. It came back up to 70 after the FTC announcement on, anticipation of another short squeeze. And now again, it has started to drift lower again into the lower $60 range. So to say that the stock has done nothing but go up since this campaign has started is
okay.
I don't know if
so
it's
all right,
I'll give you the benefit of the doubt.
It's been very, very volatile.
It's been volatile, but it's performed well.
But for the year, it is up a tiny bit, and from its low to its high, and the bottom the 1 year bottom that it made in December in the high 40s to reaching 75 before it backed off. That's a significant move up.
Okay, I'll give you that. I'll concede that. Now let me make this point. The company has failed. not to bring another analyst into this, but Tim Ramey is really the one that pounds the table on this name a lot. And since he's been covering the stock, it has failed to hit any one of his targets. And the reason the stock has moved up the way that it has is because the valuation has been expanding. This is not a case of a company that is banking more cash and shoring up its balance sheet and creating a war chest for itself and growing its cash flow stream and growing its organic business worldwide. This is a situation where a company has levered itself and continues to lever itself further with every dollar it spends on buybacks. It has put a bid under the stock from buying back stock. It has locked up a significant portion of the float with investors like Icon and any of the other names that may have followed him in there and may still have, large chunks of the float. And so from a stock price perspective, it's mostly a technical story. It's mostly, a story of supply and demand and a story of buying back stock. The valuation has just gotten more and more aggressive the higher the stock has stayed, while the underlying organic fundamentals of the company continue to deteriorate. So to make a case that multiple
the underlying
from here
fundamentals have not deteriorated. Their revenue bottomed in 2016. Going in
the guide
12-month
the guide for this year for the company 3 years ago was something like $7 or $7.50 a share. All right, and GAAP earnings they're expected to do. And by the way, free cash flow has also come way off. So in the trailing 12-month period,
I don't really look at earnings per share. I look at economic profit. I look at operating cash flow. I do look at different measurements than other people.
All right. Well,
however, economic operating cash flow also bottomed in 2016 at $590 million. For the trailing 12 months, it just ended in this recent quarter. It increased from 600 million, let's say, to almost 750 million. That's 25%. So cash flow went up in the past year, 25%. We estimate going forward at least another 6 or more percent to almost 800 million. And I believe this company can get back to its historic growth rate before you had to be distracted by all of these issues, the short selling controversy and the FTC investigation and other issues. And this stock can grow and probably surpass its recent high in revenue of $5 billion and probably grow to be $6 billion in revenue over the next 3 to 4 years.
Well, I just think that first off, we might be looking at two different sets of cash flow numbers. That's number one. But number two, to be able to say that the company is going to be able to, again, reach its pinnacle and surpass it over the next 3 to 4 years, when the list of risk factors, including many of the unknowns coming from the FTC settlement, which we'll start to see here over the next couple of quarters as these new rules have been implemented, I think it's just I just don't find that to be an accurate way to make a forward-looking analysis. I think the risk.
Well, but we have to make a forward-looking analysis that will have risks. But I have an expected growth rate and an expected trend to revenue, and there's subsequently cash flow and then net operating profit. That it will go along that trend. And every business has risk, and every business has regulatory risk. They have competition risk. They have product risk. They have headline risk. I mean, this is what the stock market is all about. I mean, to specifically single out Herbalife, yes, it has been more controversial than some other companies, but they have continued to overcome a lot of these issues, and these issues have been around for some time.
I agree with you, and I disagree with you. Where I agree with you is that all companies do have a myriad of risks, and that discounting those risks and making a forward-looking analysis is what you're supposed to do and what analysts get paid to do, right? I don't disagree with that. What I would say is that not all companies, Herbalife has a litany of risks that are built on top of a business model which has not yet been proven that in the United States it can operate with the same type of robustness and the same type of consistency and the same type of, regulatory good faith in the fashion that it has in the past.
Wait, you mean in the United States or in China? Now, are you?
No, I'm talking about the United States now.
Okay, so in the United States, the company has been around for 37 years.
Yes, but how many of those years have they operated under the? How many of those years have they operated under the FTC's new injunctive relief rules?
Okay, but the rules are new, but they not only are complying. No,
the answer is one quarter.
They are not only are they complying. Okay, they are not only
complying. You can't bring up 37 years of operating history and talk about
no. The 37 years. It's still a fact that the majority of end users just want to buy the product and not be distributors. And the reclassification of those people who just want to buy the product and not be distributors as preferred customers versus those who are business builders who want to resell the product, I think makes things clearer. The regulations have actually helped. They've made things better. The company is complying, and they are exceeding the 80% threshold. It's been 90% for the first 2 quarters that they've had to follow those guidelines.
I'm going to give you a reading assignment when you get off the phone with me. There's a fantastic article on Seeking Alpha. I think it's written by a gentleman by the name of Gary Milne, and the title is something to the effect of how Herbalife has gained its preferred number metric that it's posting. And I'd encourage you to read that article very closely when you get off the phone and look at some of the manners with which this article alleges that the company has come up with their preferred members number. The second thing I would just say is that one quarter. So one sec, let me just make this one point, and then I'll give you a minute to respond. The second point I would make is to say that everything is going fine and that they're complying and there's no issues, just based on one quarter wherein the company was just starting to implement these structural changes in the business. I think is an inaccurate way to forecast the future. We get 4, 5, 6 quarters here under our belt. We start to look at some of the trends that the company posts in the United States after this injunctive relief has taken place. And if the numbers stay the same and everything looks good, then you can come back on here and tell me that I'm an idiot and I was wrong. But to look at it for one quarter and to say everything's fine and everything's going to be fine, is taking the same type of blasé attitude that people took heading into the FTC settlement when they said, well, nothing's going to happen and we're going to be exonerated.
Well, first of all, if everything goes well for them for 4, 5, or 6 quarters, the stock won't be at 63. The stock will probably be at north of 100. So that's the risk. I
vehemently disagree.
Well, wait. If they have 6 great quarters where they've
we're talking about in the United States. This business is the numbers have been down in volume points, in member signups, in volume points are really the best, purest way to gauge the business. But if you start looking at like rolling year-over-year comps and volume points over the last 2 years, and I don't have the regional key metrics in front of me, but you can refer to the bottom of the company's last press release going back a couple of quarters, and those numbers have trended lower over the last 2 years.
Absolutely.
Around the world.
Because they've been undergoing all these investigations, and it's been distracting for both the company's management and the members and people involved. That's why revenue was down. I've said revenue dropped from a peak of $5 billion in 2014 to a trough of, let's say, $4.4 billion in the last quarter. So now it's starting to, the last trailing 12 months period, ending the last quarter. So now it's starting to go back the other way.
The fact that this company last quarter far exceeded its EPS estimates and missed its revenue numbers is a microcosm for what's going on under the surface here. Okay. It's indicative of a company who's, tried and true downtown organic, fundamental, financial, what they're bringing in the door, what they're doing on the top line. Like you said, revenue has bottomed for now. Those numbers are off. The volume point numbers are off. Now you can attribute it.
There is no secret to that.
Hold on. Okay. So what I'm saying is you can attribute it to, this has been a huge distraction for members and it's been a huge distraction for management. Okay. That's fine. You can attribute it to that. But there's also an argument to be made that actually the opposite is happening. We're in public awareness based on this, controversy over the last couple of years and based on this documentary that's recently come out and, things like this John Oliver piece that has come out is starting to filter itself into the mainstream. This has been a Wall Street story for 3-4 years. I've been researching it for a while.
The stock has been a Wall Street story. The sales of the company's products is a Main Street story.
No, I completely disagree because I've spent
I would say most Wall Street
years.
people are not really Herbalife distributors for the most part.
All right, here, let me make this point real quick. For 3, 4, or 5 years, or however long I've been working on this, I've had numbers of conversations with people that, are not in the business of finance. People that have heard of the company, they don't really understand the model. Maybe they've had some experience with, a family member or a friend who's worked in multi-level marketing or something like that. And none of these people understand the story behind the scenes. People know, they see in CNBC that, it's Icon versus Ackman, or that it's a controversial name. But people on Main Street don't really get the bits and pieces of this whole story. And what we've seen over the last year, I'm just going to finish the sentence, then I'll give you a minute to talk. What we've seen over the last year, starting with the FTC coming out and making some incredibly damning statements in their complaint against the company, which is a whole other conversation in itself. But aside from that, we've seen a documentary and we've seen a piece on, premium cable that has taken the story, distilled it into terms that people that aren't experts in finance or may not have personal interactions with the multi-level marketing industry can understand. And what's going to happen is at some point, there's going to be an inflection point where the public wises up and realizes that the business opportunity here that these companies offer may not be the golden ticket that they're making it out to be. And when that happens, you're going to see a large secular shift in the way that in the same way you've seen about pharmaceuticals, the same way you're seeing now about the opioid crisis, you're going to see a large secular shift on Main Street about the way that people think about these companies. And when that happens, this company will be so levered and the cash will potentially have dried up at that point that I think that presents a serious long-term risk. So to argue a case for multiple expansion here, I just don't see it. It just doesn't make sense.
I'm not arguing a case for multiple expansion. I'm arguing a case for business growth.
Okay, I actually want to jump in here. So you guys kind of walked around this, and I want to ask both of you, do either of you know anyone who is an Herbalife distributor or who uses Herbalife products?
Yes.
Okay, and what have they told you?
They are not really that focused on it. There are people who like the products, but there are people who like the products and buy the products. And there are people who are engaged part-time in selling it, and they enjoy being involved in it, and they make a little bit of money on the side doing it, and they more enjoy the interaction. And this is what the people are telling me, okay? The products, for the most part, people like them. They are good. I've had various products over the years from Herbalife, okay? They're good, and people like them. And they don't really, and most of those people don't really care about what's going on in the stock. Okay, they may have some interest in the market in general, as most people do. The other people, the majority of Herbalife distributors make a little bit of money selling it. You have a few people who have been involved for a long time and have a major focus that have a very big downline, as the term is in their group of in their levels. And some people who have had bad experiences because, hey, sales are hard. I mean, it takes a lot of work, and selling is not for everybody, and trying to engage with friends and people to buy things from is not for everybody. But overall, people like the products, and the distributors who are focused on it like being a distributor. And those are facts.
And Chris, what about you?
So real quick, just two little responses to that. The first is, arguing that the products are something special is just not an argument.
I didn't say they're special. I said people like them.
You said people prefer the products, right?
I said people like the products. They don't have to be special for people to like them. People like them.
Okay. So let me just make
so
a point,
I guess to the people who like them, they are special to them. Okay.
Okay. Fine. People like the products, right? That's the argument.
They do.
So I'm gonna give you two responses. One is my personal experience with the products, and the other one is why that logic is a fallacy. All right.
It's not logic. You asked me, do I know people, and I said yes, and I'm telling you what they say. They say they like the product.
I'm going to make a broader, more generalized I'm going to make a broader, more generalized response to that in general. Just the nature of the market with which their major product, for example, Formula One, operates in. So
yes.
You go to the store, you buy a canister of GNC's Lean Shake, and you get a canister of Herbalife Formula One, and you turn them both around. For the most part, the ingredients are going to be almost identical. They're almost identical products, right? One's going to be priced at a significant premium, and that's the Herbalife product, because a lot of that, premium that you pay for the product in the same canister, the same size for the same ingredients, has to move to the downlines, has to pay for this other arm of the business that operates, right? So what stops somebody from going to GNC and buying a canister of Lean Shake for $23 or $29 or whatever it is, and taking the time to go and buy the Herbalife product, which, is ostensibly going to be $39 or $49. It's, profoundly more expensive.
The price difference, no, it's not. It's not that much more expensive. And also,
it's price
you got to realize,
premium, not. The answer is yes.
I think for the price points of the products, they're a good value. I mean,
that doesn't make any sense. I'm asking you.
Okay, no, the
commoditized product that's priced at a premium to GNC's Lean Shakes.
Okay, so
okay, I'll say yes, and they still sell it. They sell a premium price product. Okay,
perfect.
There are a lot of companies
let me finish
that sell
thought.
premium price products.
Let me finish my thought.
So there is some premium.
There's two reasons to pay a premium, right? One is you make a superior product that the free market decides is a better product.
Yes.
Or perhaps you're into the social aspect of the business, and you like buying the product from somebody who's going to come over and wake you up every day out of bed and tell you to go for a run or whatever you have to do to exercise. But there's also an argument to be made.
That would be good. I would like somebody to do that.
Excuse me. There's also an argument to be made that the product sells at this premium because it's attached to this idea of a business opportunity, whether it's a part-time business opportunity or whether it's a full-time business opportunity. Now, I'm going to give you a personal story of my use with Herbalife products, and I'm going to keep it very, very short because I know Spencer always thinks that I talk too much. Years ago, when I lived in Philadelphia, I was working my way through graduate school, okay? And I made a dear friend of mine who was a professional soccer player, okay? He moved into the apartment that was next to the bar that I worked in when I was slinging beers for a living. We became good friends. We talked about soccer. And at some point, he had me over to his apartment to help him unpack his stuff from Mexico, where he had been playing prior, or actually LA, where he had been playing prior to Philly. So I did that. And upon doing that, I came across 3 enormous boxes of Herbalife products. There was all of them. There was Lift-Off energy pills. There was Formula One shake. There had to be 10 or 20 different products, right? So he asked me if I wanted them. And this was, I think, 2007, 2008. And I wasn't really even involved with Herbalife. Hadn't looked into multi-level marketing companies at all. And I said, yeah. He said, I don't want this stuff. Take it with you. So I said, fine. So I took it back to my apartment and I looked at the expiration date on everything, and everything was 2 or 3 years old. So the stuff's been sitting around for a while, whatever. I found one product that had not been expired. It was a Lift-Off. It was called Lift-Off energy drink. These little tablets, you're supposed to drop them into water, and they're supposed to create the equivalent of, having a Red Bull or an energy drink. So one day I ran out of coffee, getting ready to go for my morning run. Said I figured I'd try one of these, right? Tried it once, never touched it again, promptly took the entire box of products and put it down the trash chute. Now, that's just my personal experience with the product. I've had other friends of mine, specifically in college, that were pitched the product that had similar experiences like that. And the reason is these products are just, Herbalife has this PR notion of seed to feed. We're going to do everything from the ground up. We're going to, these products are just commoditized versions of products that are already on the market. Their arginine product is under patent from somebody else. They license the patent. It's not even something they created in-house. The thing is, when you're running the business model that these guys are running, it doesn't matter what the product is. It really doesn't. I mean, whether it's Nu Skin, whether it's Herbalife, whether it's USANA, whether it's Longevity, whether it's any of these multi-level marketing companies, they're selling you a story. They're selling you a narrative. They're selling you a business opportunity, but what they're not selling you is a product that is in any way profoundly different from something that's on the shelves already and priced usually a lot cheaper.
Okay, so
the free market decides what people want to buy, and people.
Excuse me?
The free market decides what people want to buy, and there are people who like Herbalife products and they buy them.
Okay,
you are correct, but would they be buying them if the product was not stapled to a business opportunity? What's the point of buying?
But the people who are just using them to consume them, remember, are outside of the business opportunity. They buy it because they like it, and nobody would buy a product that they didn't like.
Because nobody's going to volunteer to pay 20 or 30% more for a product that they can go out and buy from GNC or have shipped to their house.
But not
GNC.
not everybody who uses or consumes Herbalife products are distributors. The majority of the people are end users. And this has been the controversy. And this is what's coming out. They are end users. So either they buy the product because they like them, or they buy the product because they like the person selling it to them and they like the product. Okay? Nobody is going to buy a product that they don't like. And nobody's going to buy a product from somebody who they like, even if they don't like the product. Okay.
So your argument is that if you go out to buy a Mercedes tomorrow and there's a dealership that's a mile from your house that's selling the model you want for $70,000, but you got a cousin that works somewhere, who you want to give some commission to, who's selling the same exact car for $92,000, that you're saying most people
I would
expect
my cousin to sell it to me cheaper.
Okay,
by the cousin selling the product. I would absolutely. I would expect it to be cheaper, and I'm sure people do. But you're saying people still attach value to the Herbalife products, and they like them.
Okay,
I'm not going to pay $20,000 more for a car because I like the guy, but I would pay the same price because I like the guy. Okay, and
many of the participants that participate in Herbalife's business model and who use the product on their own, some of whom I've met over the years as I've been doing a lot of research. Many of these people, are regular middle-class people that, to make the argument that they would go out and volunteer to overpay for a commodity product for one reason or another, as opposed to going and getting it at a 15%, 20%. I mean, here's a question. Why can you go on eBay right now and buy the product at a discount to what the suggested retail price from Herbalife is? Why is eBay flooded with Formula One that you can buy right now at a discount?
Because eBay is flooded with all kinds of products you can buy at a discount.
But fundamentally, from a
that's
free
why
market
people do buy on eBay. People look. You can buy brand name products on eBay at a discount.
Why is the supply there?
Do.
Why is the supply there?
Why is the supply there? Because the demand is there.
Okay,
I mean, that's not true. Hold on.
I want to jump in here. And you guys aren't letting me.
Wait, if the demand is there, the product. Wait. If the demand on eBay is there.
That's what I'm saying.
You're saying that people want to buy it on eBay. So maybe people like to get the product at a discount. That means they like the product and they like to save some money. There's nothing wrong with that. I do that with the product I like.
Okay.
Yes, but if it's not the company that's selling the product on eBay, what possesses people that have gone out and paid the premium for this product? That the average selling price.
Well, I don't believe people are paying a premium and then selling it on eBay at a loss.
Well, then you should do some research because that's exactly what's happening.
Okay. All right. Last question.
You're thinking that people are buying the product from Herbalife and then putting it on eBay at a loss.
So the company is not listing the product on eBay. So we know it's not them.
I understand that.
So it's people that have bought the product for one reason or another and are reselling it. And they're reselling it at a discount. And they're reselling it at a discount,
not at a loss.
All right, Ivan.
Wait a second. No. It's a discount to what they paid, which is a loss for them.
Wait. No, it's not. So somebody's business model is to exist buying a product from Herbalife and selling it on eBay at a loss. I'm not saying that there's not product on eBay.
It doesn't make sense, right?
Well, no, but why do you say they're selling it at a loss?
Look, you're arriving at the same point that I am, which is it doesn't make sense. The supply is there.
Well, no. Because yes, the supply is there because the demand is there. You're saying, why are people selling Herbalife products on eBay? Because I'm sure there's people who like to buy it on eBay.
No.
Okay.
Assuming supply and demand is a zero-sum game across all mediums. a website like eBay or Amazon, and I'd encourage you to go online and look at different websites where you can buy product that's being resold. That supply
I'm sure
is
it's there in everywhere.
Because
I've seen Herbalife bars in a deli where the guy may be an Herbalife distributor and he buys bars and he puts them by the counter, and you can buy the bars one at a time from the box, or you could buy a whole box. That guy's not losing money selling them.
So there's Herbalife
sell
supply.
them in different channels.
There's Herbalife supply everywhere. I think we can agree on that. I want to wrap up here. Same question to each of you. I'll start with you, Ivan, and then I'll go to Chris. Ivan, what would change your mind about Herbalife as an investment?
Well, significant negative sales trends that could not be reversed. That would be a start.
Okay.
I don't mind the controversy. I mean, in controversy, there's opportunity, and and every recommendation doesn't always work. But I believe there's a number of good fundamental points supporting the fact that the stock will go higher.
And Chris, what would change your mind about Herbalife? What would make you bullish?
Look, I just to calm it down here for a second, I completely agree with Ivan when he says that controversy creates opportunity. I think he's right about that. And I don't think, I just find this particular analysis misguided, but there are situations and circumstances where I would change my mind. And I've thought about those. So for instance, if the company had gone out and perhaps been acquired had gone out and acquired, a retail company like GNC, where they could start to merge the multi-level marketing model with the traditional model. That would be an instance where I would have to sit back and really reconsider the scenario. Or, if from a technical perspective, another larger investor came in, or Icon decided to continue buying his stake up to 30%, 35%. I mean, these are very real scenarios where
he has increased it a lot.
Excuse me. He has asked for permission to buy up to 50% of the company, and he has made token buys when the stock has crashed or when the narrative has not benefited him, and he's done nothing else since then. Okay, let me finish my thought. The point of the matter is there are scenarios where I would reconsider the analysis, but it's always going to be on top of the fact that the model that they have been running and the model that they continue to run, to me, does not appear to be a sustainable model. I mean, Ivan, why have they stopped publishing their total number of members in their annual report? This is something they've done every year. It went all the way up to 4.1 million, and then they just decided, let's not talk about it anymore. Why would you omit a disclosure like that? Or why would you omit, a disclosure like...
And yes, I agree. More information is better than less. And certainly everybody would like to see it.
So there's definitely situations and circumstances where I would reconsider my thesis. As it stands right now, I think it's probably one of the most attractive times to, present or advocate for the bear case over the last 3 years. But to Ivan's credit, you know what? It's not the first time I've said that. And I've been wrong many, many times in the past.
All right. Thank you both so much. Ivan Feinseth, he's the partner and CIO and head of research at Tigris Financial Partners. Chris Irons of Quoth the Raven Research. Thank you both so much.
Thanks, Ivan. I appreciate it. Thanks, man.
Nice to meet you. Thank you.
Bye-bye.